Good day, fellow investors. I still think that ADM has still 30 to 50% upside from the current levels. We discussed it a month ago where I told you that the accounting issue was just for the nutrition part, which was just 10% of the business, thus not significant when the stock was at 52 and it was much cheaper than earlier because the market was scared for the wrong situation. They just reported the delayed earnings. The stock is a little bit higher, but still down from the earlier, let's say, levels, and therefore there is still a relative room for growth. I think it can go even to 80, maybe 70, but with the company's buybacks, it should go higher, all else equal. We'll discuss that too in a moment. They have provided an update on the investigation in the nutrition segment, and the key is that here it was all about intercompany transactions, and those intercompany transactions get all cancelled out when it comes to a consolidated statement that matters for you as an investor. But for tax purposes and other purposes, it is very important that there are fair market prices shown in that transactions, because holding companies pay taxes on a local government basis. So it's important that there are things in check and that there is a clear framework going forward. As the nutrition segment was a recent acquisitions, likely they didn't fix that well over time. Nothing significant, nothing meaningful, so we can put that aside and continue going on. It's a huge business, so that is very normal, especially in the food industry. Focus on the earnings call. We have seen numbers still very strong, $7 of earnings. That gives you a single-digit price to earnings ratio. However, the trend is down a little bit from 2022, and that is also expected similarly in 2024 as the food cycle is reverting a little bit. Now, if we look at the cash flows, 4.7 billion in cash flows, capex 1.5, which leaves 3.7 for dividends and share repurchases to reward shareholders. Compared to the current market capitalization of 30 billion, expecting future earnings to be a little bit lower, we are still looking at a 10 to 9% free cash flow yield. As I said, the guidance for next year is down, so from 7 and from 8 in 2022, we are going to a range between 5 and 6 in earnings per share, which still leaves, if we go from 4 to 5 billion in operating cash flows minus capital expenditures, it still leaves 2.7 billion in free cash flows to reward shareholders, which is not a bad number. And let's now go to the conference call, because there you will get the details for what is going to happen next with the company, which is also the right focus of the analysts. Juan Luciano discusses how they had 92 years of dividends, 51 years of increased dividends, and I think that will likely continue as they just need 1 billion to pay that dividend. However, the key here is that we know that 2024 will be a more challenging year than they faced in 2022 and 2023. They see that the tailwinds that supported a portion of their performance over the past few years have been changing direction, and therefore also the lower guidance. But lower guidance, they are still swimming in cash, increasing the buybacks, and when a company increases the buybacks, that usually means that the stock goes up. Now, great question here. First question from Adam Samuelson from Goldman. He asks, how can we think about the long-term normalized earnings going forward? And the answer is that the CEO doesn't give us the specific answer in billions, but that margins we're going to moderate is their forecast already since 2021, and now we are seeing that, but that the margins in 2024 are still higher than average. So if you're looking at normalized earnings for the company on average margins, we are closer to the, let's say, 3 billion in operating cash flows minus capex, 2 billion in value creation on the normalized earnings, which gives you a P ratio of 15, which is nothing special, but also not stellar. And there were discussions going forward why they expect things to improve in 2025. Of course, they expect things to improve, but there is no guarantee. And also, the CEO is not allowed to say, oh, it's not going to improve, because every next contract discussion that he will have or the company will have, the buyer will say, oh, you said prices will be lower. Give me immediately lower prices. So, of course, they need to protect themselves and say things will improve always, but you never know. And that is the key risk when it comes to ADM, that the food cycle is reverting on the negative, and therefore we will see how will 2025 look like. 2024 is already down, but still on higher than average margins, which is key. This is the key. Hopefully 2025 will be a positive year versus 2024. Hopefully is the key here. Similarly, others then ask, okay, how are you going to go back to the $7 earnings per share target? Okay, you have buybacks, but what are the controllables versus cyclicals? And the answer there is, we hope reversion cycle, nutrition growth, but it is all about hope. Despite that hope, if you look at it from a normal cycle perspective, it's still 2 billion. Let's say even in a downturn, 2025, that will be reflected differently by the market because it will be more pessimistic and the stock will go down. Maybe till 2025, also with lower cash, there will be no repurchases. So we'll could see the stock price going up and then down if the news are negative. So if you want to ride this, most likely risk and reward situation now is the stock will continue to go up at least until the next earnings or mid-year when things will be clearer. So that is the relative stock valuation, 2.5 billion on a normalized cycle going forward for dividends, extra cash flows on buybacks, the stock should go up. And it could easily just be pushed back to where it was earlier. These were positive time cycles, now we are negative, let's say we go into the middle again, and that is the positive. But this is a value investing channel where we don't focus on relative returns, we focus on absolute returns. And let's do a value investing valuation. If I go about it, cyclicals are to be bought at 20 to 25% cash flow yield from average cycle point yield. The average cycle cash flows, let's say 2.5 billion, and compared to the market cap, that is an 8% return. If I want to buy it at, let's say ADM is a truly great long-term outstanding business, maybe 20% is for miners, 15% for ADM, that's a market cap of 16 billion. Given the quality, let me be at 20 billion, so let's say 30% down from the current level is around 30 or 40, and we have seen those levels. These are the really great opportunities from a value investing standpoint. However, now there is still downside. If 2025 is negative, 26 is negative, then you have time to accumulate, maybe even reinvest the dividend if you go for the current strategy. It's unlikely that over the long term, given the dividend, you will lose money given the strength of the company, a quality business in a portfolio, as long as you know what to expect. along that food cycle. So what is my strategy? I'm not adding ADM to the covered stock on my research platform yet, and I have there Wilmar. I waited for ADM's results. Now I'll update likely next week, which is their joint venture, 25% owned situation in Asia, where there was some weakness, and we can see there maybe the food cycle develop faster, which is then an interesting thing on much cheaper valuations because it is Asia. Thanks for watching. Check what I do on my research platform. Don't forget 21-day money back guarantee. See you in the next video.